So when you hear the term merchant banker, what's the first thing that pops into your head? Probably a massive, headline-grabbing IPO, right? But that's like saying a world-class chef only knows how to make one dish. Today, we're going to open up their entire toolkit and look at all the incredible ways they shape our financial world.
Which brings us to the big question. What does a merchant banker really do? Beyond the splashy headlines, what's their day-to-day impact on the market? Well, as we're about to find out, the answer is a lot more complex and, honestly, way more interesting than you might think.
Look, we all see the big stuff, the blockbuster IPOs, the massive mergers. That's what gets all the attention. But the deeper reality, the real work, is often happening behind the scenes. We're talking about handling government disinvestments, guiding companies through share buybacks, and acting as this crucial engine for small business growth.
All right, so here's our game plan. We're going to dive into their toolkit piece by piece. We'll see how they help the government sell off assets, how they reshape a company's entire stock structure, how they get small businesses off the ground, and even how they play a role in private funds. It's all going to paint a much clearer picture of just how essential they are.
Okay, first tool from the kit. This is a big one, and it's highly specialized. Helping a country's government sell its assets. Welcome to the very complex art of disinvestment.
So what in the world is disinvestment? Well, simply put, it's when the government decides to sell its shares in a company it owns, what's called a public sector undertaking, or PSU. And let me tell you, this isn't like a simple stock trade. It's a huge strategic decision that needs some serious expertise to pull off correctly.
Now, this whole process basically boils down to two main approaches. The government can do what's called an offer for sale, which is kind of like an IPO, where they sell shares to the public on the stock market. Or they can do a strategic sale, where they sell a big, controlling chunk of the company directly to a single private buyer. Two very different paths with very different results. And this is where the merchant banker becomes absolutely critical. They're not just a middleman here, they're the advisor. They figure out what the company is actually worth, they manage the entire complicated bidding process, and they make sure every single rule from DPAM, that's the government's asset management arm, is followed perfectly.
All right, so we've seen how they help governments sell. Now let's flip the script and look at the tools that help companies buy, specifically buying their own stock. This is where a business can fundamentally change its relationship with the public market.
But that kind of begs a question, doesn't it? I mean, why would a company that probably spent years and millions of dollars to go public suddenly want to buy its own shares back? Or, even more dramatically, why would it want to just pack up and leave the stock market for good? Turns out there are some pretty smart strategic reasons.
Okay, let's break this down. A share buyback is when a company goes into the open market and buys its own stock, reducing the total number of shares out there. This can help boost the value of the ones that are left. Now, delisting, that's the final step. The company completely removes its stock from all exchanges. It's officially going private. And you can bet these things are tightly regulated. Take those buybacks. A company can't just go on a wild shopping spree. There's a hard limit. They can't use more than 25% of their paid-up capital and free reserves. That one number is huge. It keeps companies from getting themselves into financial trouble.
When it comes to delisting, think of the merchant banker as the project manager for the whole operation. They get hired by the company's founders or promoters, and they handle everything. They set up secure accounts for the shareholder payouts, they navigate this incredibly complex web of rules from SEBI, the market regulator, and at the end of the day, they're the ones who officially announce if the deal was a success or a failure.
So far, we've been talking about the big players, right? Governments, huge corporations. But what about the little guy? Well, it turns out merchant bankers have a vital tool that makes them a critical engine for small and medium-sized businesses looking to go public.
You see, for most smaller businesses, the public market can feel like trying to get noticed in Times Square. It's tough. Their shares don't trade very often. That's what we call low liquidity. And honestly, not many investors even know who they are. This makes raising the money they need to grow a massive uphill battle.
So how do you solve that? Well, there's this really clever mechanism called compulsory market making. It's a rule that says the merchant banker who takes a small company public has to promise to create a market for its shares. They have to be ready to both buy and sell the stock for a certain period, just to make sure investors can always get in or out.
This really shows you the deep level of commitment we're talking about here. It kicks off with 100% underwriting, which is a fancy way of saying they guarantee the company gets every penny it's asking for. Then comes the intense due diligence to make sure investors are protected. And finally, that market-making promise kicks in, providing that crucial liquidity for at least 3 years. It's a full package deal.
All right, for our last tool, we're stepping away from the public markets and into the more exclusive world of private money.
We're going to look at the merchant banker's role with something called alternative investment funds.
First things first, what the heck is an AIF? The easiest way to think about it is like a private investment club for very wealthy or institutional investors. It pools their money together to invest in things you couldn't normally access, like startups, private real estate, or complex hedge fund strategies.
Now here's the catch. An AIF can't just go out and start raising money. It has to file its main investment document with the regulator, SEBI. And, you guessed it, it has to be filed through a merchant banker. The banker acts as a professional gatekeeper, and they have to provide a certificate saying they've done their due diligence and everything looks legit.
So when you pull it all together, it's pretty clear, right? The role of the merchant banker goes so far beyond just crunching numbers for an IPO. They're part strategic advisor, part regulatory expert, and part market maker.
Let's just quickly recap the whole toolkit. When the government is selling, they're the process manager. For a share buyback, they're the compliance cop. For a company that wants to delist, they manage the whole exit. For a small business IPO, they're the underwriter and the liquidity provider. And for those private AIFs, they're the ones giving the regulatory stamp of approval. Each job requires a totally different tool.
You know, there's a great way to think about this. The merchant banker is really the financial architect. They aren't just putting up walls or laying pipes. They're designing the entire blueprint for a company's most important and strategic financial decisions.
Which leaves us with one final thought to chew on. After looking at all these different roles, from enforcing rules to helping small businesses find their footing, is the merchant banker more of a gatekeeper whose job is to protect the market, or are they more of a guide, actively clearing the path for companies, governments, and investors to move forward? Something to think about.